Welcome to S&P's first European loan market video overview. I'm Suchit Gupta, a member of S&P's Leveraged Commentary and Data team, a unit of S&P that is not affiliated with S&P Ratings. For the next few minutes, I'll walk you through a review of recent loan and high-yield bond market trends in Europe, before winding up with themes to watch for in April. Please know that you can follow LCD on Twitter, and you can join the more than 3,200 contacts in LCD's Leveraged Loan Group on LinkedIn. Before getting down to business, some fine print. This disclaimer, courtesy parent companies Standard & Poor's and McGraw-Hill, covers all the bases. Please read it at your leisure. After losing roughly a point in February, bids on loans in the secondary market rebounded in March. The slide in February was due to heightened concern around sovereign risk, which also spooked the equity markets, resulting in several IPOs being postponed. With the sovereign crisis abating, however, loan flow names have rebounded. The reason for this resilience: supportive technicals and improving fundamental conditions. Technicals were bolstered in March by hopes of improving repayment rates, as IPOs reappear on the horizon and as high-yield bond issuance revives. As well, money continues to flow into U.S. loan mutual funds and high-yield funds, which are a reliable barometer for European fund flows. Improving fundamentals were seen in the default rate. It has now receded 3 points from its December 2010 high. As for new deal flow, there's certainly been a lot of activity this year, but it has been geared far more towards the high-yield market rather than loans. Almost half of the loan volume year-to-date is for M&A purposes, with the rest split between refinancings and recaps. Finally, though the markets recovered its ground lost after February's mid-month scare, market players acknowledge that they're far more concerned about an exogenous shock to the system, a spike in oil prices or inflation, for instance, than they are about market technicals proper. Getting back to the loan market rebound, we'll start with a big picture view. This chart details the average price of LCD's European Flow Name Composite, a measure of the 18 largest, most liquid loans consisting of 10 issuers since 2002. As rollercoaster ride since 2007 illustrates, the loan market, which once immune to volatility, has rebounded from the devastating losses of late 2008, early 2009, and the turmoil that largely accompanied the collapse of Bear Stearns and the woes of Lehman, Merrill Lynch, and AIG. As of April 1, 2010, the average loan bid for the European Flow Name Composite stood at 96.41. Focusing on the last few months, the secondary market has been mostly calm compared to the extreme swings in pricing seen in late 2008 and 2009. February's Greek debt crisis caused some weakness, but loans have been stable to remain positive this year. Looking ahead, market players expect prices to be well supported thanks to rising repayments from a combination of IPO proceeds and high-yield takeouts, and also thanks to a dearth of replacement paper. This chart details the monthly return of the S&P European Leveraged Loan Index, a broad measure of European loan market returns that LCD calculates. There are three components to LE returns. The first, interest return; the second, market value return; and the third, currency return. The European loan market posted a gain of 0.71% for the 4 weeks ending March 25, 2010, a turnaround from the loss of 0.56% in February 2010. This brings the year-to-date return to 3.93 versus a negative return of 3.78 for the same period last year in 2009. From the secondary, we turn to the primary. This graph details new issue volume for both leveraged loans and high-yield bonds. To be sure, the European high-yield market's been on fire over the past 6 months, with a plethora of issuers taking advantage of market conditions to refinance existing bank and bond debt, often with the aim of pushing out maturity profiles. All but 3 European high-yield offerings this year have been used to refinance existing debt, and more refinancings are lining up. Ineos and Ziggo, formerly known as Casima, are 2 of the bigger names. Loan issuance, although stronger than last year, has lagged. More than half the new loan issuance in 2010 has backed refinancings and recapitalizations, while on the M&A side there have been various secondary buyouts, such as Pets at Home and Marken, but large brand new buyouts remain disappointingly scarce. This lack of new issuance is gradually taking its toll on the overall amount of debt outstanding in the European leveraged loan market. This chart details the volume of institutional term loans outstanding, according to S&P European Leveraged Loan Index, or the ELI. Institutional repayments are trickling in for now, but as the high-yield bond and IPO calendars build, that could turn into a torrent. Coupled with a lack of actual new issue in the primary, this inventory squeeze continues to underpin secondary price levels and wet demand for new issue paper. It's just not supportive technicals that have underpinned the loan market. Fundamentals have been improving as well. These charts give two views of the European loan market's default rate based on the ELI. On the left, by number of defaults, on the right, by principal amount. The formula is similar for each. For default rate by number of loans, we take the number of loans that default over a given 12-month period, divided by the number of loans outstanding at the beginning of that period. For default rate by principal amount, we take the amount of loans that default over a 12-month period, divided by the total amount outstanding at the beginning of that period. After an unprecedented rise in 2009, default rates have started to recede. The reason is twofold. First, the weakest, most over-leveraged issuers have already succumbed to either payment default or restructuring. Second, the heavy burden of defaults that struck in the first quarter of 2009 is now rolling off the 12-month dataset. Meanwhile, more issuers are able to avoid a restructuring by merely amending covenants or by improving their balance sheets via bond refinancing. In summary, first, sponsors are focused on exits in order to make distributions to their LPs, which should generate more IPOs and secondary buyouts. Second, companies are focused on managing their balance sheets to create financial flexibility through bond for loan takeouts or potentially through amend to extend transactions. As a result, a rise in repayment rates is anticipated due to more IPOs and bond for loan takeouts in the coming months, as well as fund inflows. But the forward calendar of true new issue volume remains weak. This means the loan market should remain technically strong. And finally, most participants expect default rates to continue to ease. That brings us to the end of our overview. I hope you found it informative. We'll update the analysis each month and plan to have analysis of other specific European market segments going forward. Check out LCD's YouTube page for other video analysis of the leveraged finance market, including U.S. loan market wrap-ups for March and April. The link to the page is in the description for this video. For more information on LCD news or research in Europe, you can contact Anna Cini. You can email her by clicking on the link in the info box. Thanks very much. We'll see you soon.